Okay, good evening and thanks for coming. So I know it's Thanksgiving tomorrow, and I didn't know if anybody would show up, so thank you guys for showing up. And so today we're going to do just one chapter, and so I'll try not to go, 2 hours. I'll try to do it as fast as possible. So we'll see what we can get done. But let's try to get through the chapter for today, which is chapter 14. Okay, and so we've got a couple topics left basically, and we did the stuff, the intro to macroeconomics. We did the fiscal policy material, and now we have a few more things to build up to monetary policy. Monetary policy will be next week, but today I'd like to do kind of an intro to money and banking, which is chapter 14, and so that'll be today's topic. Sure. So we can go ahead and go to. All right, you can open up the chapter 14 study guide. Okay, and you can open up the PowerPoint for chapter 14 as well. That is shared. Okay, so chapter 14 is going to be kind of a nice intro on money and banking, so money, banking, and financial institutions. And this will give us the material we need for monetary policy, which we'll talk more about and finish up next week with chapter 15. All right, so first let's just start with money, the formal definition of money. And so there's three functions of money. On slide 2, we'll start with that. Okay, so there's three basic functions of money that we need to know about, and those are these three. So first, it is a medium of exchange, so it's used to buy goods and sell goods. All right, so that's one thing. The second thing is it's a unit of account, so you can access or look up your value in dollars. So things are valued in dollars, so you know how much something is worth, or you can sell it for if you convert it to dollars. And the third thing is it's a store of value, and so individuals or households hold some of their wealth as just money, and that's because it's the safe. It's you don't have to worry about the risk of interest rates or stock and bond prices, and so it functions as these three functions here. So it's a medium of exchange, one, it's a unit of account, two, and it's a store of value. Okay, and these are all important features of money or important functions of money, but probably the most important in terms of why money is useful and why it's universally accepted is that's its medium of exchange. So this is probably the most important. All right, and that's because without this function of money, you wouldn't have a universal currency to buy and sell goods. So the point here, the value of this function, is that anyone knows that they can sell their goods and services for dollars or currency or money, and anyone knows they can buy goods and services with money or currency. Okay, so these are the three main functions of money, but the first one, the medium of exchange, probably being the most important. Okay, so the next thing is let's define liquidity. So you might have heard this concept before associated with money in banking or just money in general. But I just put, there's a lot of definitions in this chapter. And so I tried to put some links or some formal definitions to the things that weren't defined in the PowerPoints. So the key concepts that are highlighted, I have a little definition and a link down here. So let's just go through these real quick. So liquidity, the first thing. Okay, so liquidity is basically how quick you can convert an asset into cash, right? How liquid it is. And so what is financial liquidity? And so this is how easily something can be converted, or some financial asset or property or anything can be converted to cash. And so the quicker or the faster you can convert that thing into cash, the more liquid, right? So stocks and bonds are pretty liquid because you can sell them probably at like an overnight exchange, or now you can do it online now. But things like property, plants or equipment or houses, things that take longer, even months, to go through an agent, and those are less liquid because they take longer to convert that asset into cash. And so your checking account's liquid because you can just go to the ATM right now and probably get cash from the ATM machine. But things like land, again, you can sell it. It's worth a lot depending on the sticker price, but it takes longer to convert it to cash. So basically, the quicker you can convert it to cash or currency, the more liquid, right? Okay, so there's a little link to that article if you're interested in that. And so liquidity, the definition of that will set us up for the other two definitions of money. And so we have two uh, definitions of money called M1 and M2. So the first one is the most liquid definition of money. All right, so M1 on slide 3, let's look at that. Okay, and so M1 is basically the most liquid forms of money. So this is just currency. Currency is obviously liquid because it's already currency, it's already cash. And then checkable deposits because those can easily be converted into cash. So the two most liquid assets combined, this makes up the definition of M1. Okay, so M1 is basically just currency plus checkable deposits. Okay, and this includes any financial institution that issues or takes checking accounts. And so most commonly commercial banks. You can have any savings and loan institution, you can have mutual savings banks, or you can have credit unions. So any institution that officially offers a checking account, you want to add up all those checking accounts for checkable deposits and the currency, and that is the definition of M1. All right, so if you recall the data or the data website from the Federal Reserve we were looking at last time or the time before, I made a link to the actual M1 in the U.S. economy because there's been some interesting trends lately. So if you look at what's happened to the M1, which is again just plus checkable deposits in the United States? All right, so as you can see here, this is M1 in billions of dollars um, weekly. So you can see kind of the trend here since from 1975 on. But look at what's happened recently. If I zoom into the more recent trends, okay, so you can see the kind of the normal trend or the normal behavior you'd expect with the M1 money stock. It kind of grows over time. But look at what's happened since about February this year. There's been a lot more people, or there's the total number of currency and mostly checkable deposits has gone up a ton, and that's probably because number one, the economy is in there's the state of the economy is questionable, and the safest place to hold your money is checkable deposits, or just put it. Nothing can happen to your checking account, and there's a lot more people, or a bigger percentage of the economy that's saving, and so a lot of households are worried about if they'll if they'll need this uh, currency and checkable deposits for the future, and so we're seeing a lot more saving, which means not spending, and we're also seeing a lot more people hold their assets as checkable deposits or currency because it's the safest asset. So you can clearly see that there's been some unusual or some unexpected rise in the M1 money stock since the pandemic started because again, number one, it's the safest place to hold your money, and number two, people want to save because they want to have that money for a rainy day, which is now. Okay, then there's also another definition of money called M2, and let's look at that on slide 4. So this is M1 plus. Okay, so it's like kind of informally M1 plus near monies. And so these are things that are pretty liquid, but not as liquid as M1. So these are things you can turn into cash pretty quickly, but not instantly. So these are pretty much savings accounts, things that are kind of like savings accounts. So savings accounts, money market deposit accounts, small time deposits, which are kind of like savings accounts, and then money market mutual funds, which are a little bit different. But I think if these all kind of relate to savings accounts and savings deposits. So this is the biggest proportion of this M2. And so if you think of M1 plus all the things that are pretty close to liquid, but take a little more time to convert to cash, that's what M2 is. So M1 plus near monies is our M2. All right, so if you look at the data for this, you'll see the same trend. I'm going to show you a huge upward increase or trend in M2 because, again, a lot more people are putting their money in savings accounts and not spending it because of the unpredictable nature of the future of the economy. So here we go. All right, so look what's happened. So here's the over time. This is what I normally show the class. All right, and then this has happened recently, and so this is clearly something that was unpredictable and something that's only happened recently. And let me zoom in again. Okay, so you can see that this normal, upward normal flat trend continued till about March when the pandemic started in the United States, and there's been a huge sharp increase in money held at M2. And so a lot more people are not spending, they're by definition saving and leaving their money in checking and savings deposits because it's the safest, and they're not sure if they're gonna have a job, etc. And so this is clearly something that's not been seen ever since the money stock was recorded. Okay, actually, another reason why this is the case, why people are holding more money in currency and savings accounts and checking accounts is because the interest rates are super low, and so at some point your interest rates on other investments become so low that you might as well just put your money in the safest place, which is a checking or savings account, because if you're not going to earn much interest in other investments, then what's the point of taking the risk? So a lot of things are playing a role for this, but you can clearly see what's happening to M1 and M2, and it's something that hasn't been seen really ever. Okay, so those are the functions of money. That's what liquidity is, and those are the basic definitions of M1 and M2. All right, the most liquid assets, and then liquid assets plus near monies. Okay, and then also the historical or the recent break in the trend is of notice. Okay. Let's talk about the Federal Reserve, which is the central bank of the United States, and that's going to be found on slides 8 through 13. So this is something you're probably familiar with and something you've heard a lot in the news. What's going on with the chair of the Fed and the Federal Reserve, which is going to lead to monetary policy in the next chapter. So first, let's just talk about the Federal Reserve. Okay, so the Federal Reserve is the central bank of the United States. There's a board of governors, and there's 12 main reserve banks, and I'll show you a little map, I think, on the next slide. And this is the central bank of the United States, and they're also quasi-public banks. So the actual big Federal Reserve banks are also normal banks. Customers can bank at them, right? And so you look at this flow chart, I guess. Okay, so you got a Federal Open Market Committee that tries to set policies that influence interest rates, which we'll talk about next chapter. And you have a board of governors, and you have 12 big Federal Reserve banks that oversee a certain region. And they oversee the commercial banks and the thrift institutions, which lend and hold money for the public. Okay, and actually, I put a little link. So you're probably familiar with commercial banks, maybe not so much of thrift institutions. And so I put a little web link on just a little comparison of commercial banks versus thrift institutions. So under the study guide section, if you scroll down, you see thrift associations defined. All right, so it's a nice little article in Investopedia explaining just the little differences of thrifts versus commercial banks. And basically, thrifts are associated with home loans like the home loan process. And so, if you can't get a home loan through a bank, you might go through a thrift institution. And so, it kind of explains the little background on the two. So, take a look at that. But basically, thrift institutions are like commercial banks, but they specialize in home loans. Okay. Okay, back to the Federal Reserve. Okay, this next slide shows the 12 banks, the 12 main Federal Reserve banks, and the region they oversee. And so you can see that if you're living in California or somewhere on the West Coast, you're under jurisdiction of the Federal Reserve Bank in San Francisco, which oversees all these green states in Hawaii and Alaska. And then this particular bank, like the Minneapolis Federal Reserve Bank, oversees this purple region and so on. So even though it looks like San Francisco has a lot of jurisdiction, the specific colored region is overseen by that Federal Reserve Bank in the main city, right? So there's 12 main Federal Reserve banks in the cities with the dots. So they're mostly capital cities. Okay, so we're going to talk a lot more about the Federal Open Market Committee, which is the committee which conducts monetary policy, and that's all about Chapter 15. And so this aids the Board of Governors in setting monetary policy, which is what we're building up to next time. And they conduct big open market operations, which we'll explain later, but that's basically they're buying large scale government bonds. And by doing, they're holding the asset like a piece of the government, and the government gets more liquidity, which they can spend on the economy. Okay, and so they oversee all these commercial banks and thrifts throughout the United States. And there's probably about 7,000 commercial banks and probably about 9,000 thrifts. And those are overseen and work with the Federal Open Market Committee. Okay, so some main functions of the central bank, which is the Federal Reserve. They issue currency. They actually print official money. They set reserve requirements, which are the amount of money that banks cannot lend out. Right, they're going to keep some on reserve, kind of like in the virtual vault. Okay, the Fed lends money to banks, right, at some interest rate. They collect checks. They act as the fiscal agent for the U.S. government. So basically, like again, with the open market operations, the Federal Reserve can buy government bonds or securities, hold those securities, and then with that transaction, the federal government in the U.S. gets the money, and they can use it to help the economy. Okay, the Fed supervises the banks in their region, and even more importantly, they use their policy tools to try to control the money supply. All right, so last important fact about the Fed is the independence of it. So it is not part of the U.S. government. It's a separate institution. So it was established by Congress as an independent agency. It's technically not affiliated with the U.S. government. It's not part of Congress or anything like that. So this, in theory, protects the Fed from political pressures. But the thing is that the president appoints the new chair, so there is some political pressure. But technically, it's not part of the U.S. government. They can do whatever they want. Okay, and so the point of that is it enables the Fed to take actions to increase interest rates or lower them uh, to influence inflation. So you're probably aware that the Fed has used its policy tools to make interest rates super low at the current moment to try to stimulate investment. And that's been successful, or the interest rates lowering has happened. What hasn't happened so much is enough investment. And so their policies have worked, but the effect not so much given the kind of the recession we're in. But we'll talk about what they've done in addition to their normal monetary policy next time. But basically, what they're trying to do is control the money supply and try to influence interest rates to try to increase or decrease investment. Okay, so let's talk briefly. We have a few slides, and we could spend a lot more time on this, but we're not going to in this class. But I want to talk briefly about the recession before this one, the financial crisis of 2007 and 2008. All right, so let's look at slides 15 to 18 and just go through some key points on the financial crisis. And there's a video that I'd recommend watching, and you're probably well familiar with some of the literature and points from there. But I just want to cover this because this is where this fits into the syllabus. All right, so the financial crisis of 2007 and 2008 also led to the Great Recession, or the big recession we learned about from 2007 to 2009. And so this was caused by a mortgage default crisis. And there were many causes, which we'll just highlight briefly, but there were government programs that encouraged home ownership. And so before the crisis, uh, the government had programs which were intended to encourage more people to buy homes, and that was a successful program. The problem was people bought too many homes and homes they couldn't afford, and basically the problem or the program worked too well. Okay, and this led to declining real estate values because people weren't paying the mortgages, and there were bad incentives. And we'll talk about something called mortgage-backed bonds or mortgage-backed securities, which were the financial asset in which led to the failure of this financial crisis. Okay, and you had this securitization, which was basically slicing up and bundling groups of loans into new securities. So you had a financial asset that you could buy or sell, which was made up of a bunch of different assets, and you didn't really even know what was in there. You just knew what the price was. So the risk associated with these bundled securities was very much unknown. Loans defaulted, people stopped paying their home loans, and that was a big problem because people saw that the value of their home was worth less. They hadn't even paid off enough to, try to keep the home. And so the best thing to do was for a lot of people just to walk away because the money they owed wasn't worth trying to keep the home. Okay, so basically a lot of these the loan home loans were structured in such that at the initial points the interest rates were very low or close to zero, and then after a few years the higher interest rates would kick in, and once the higher interest rates kicked in, the home customers were like, forget this, I'm not paying this high interest rate, right? So it had a bad it got people to buy homes, but down the line it didn't work too well. Okay, and so you're probably familiar with some of the big institutions that failed or nearly failed. So some huge banking and lending institutions failed countrywide, which was the second largest lender. Washington Mutual, Wachovia, and then other really big banks or loan associations almost failed. And there was a huge government response, and this is the slang term of this. This was like the big bank bailout in 2008 or so, 2007, 2008. And so the Troubled Asset Relief Program, or TARP, this allocated $7 billion to make emergency loans to the big banks in order to kind of prevent the whole financial institution from going under. And some, like I said, some of the big institutions failed, but this same saved a lot of bigger ones from going under. So this was the big bank bailout that happened after that banking crisis. Okay, so I have a couple um, paragraphs on mortgage-backed securities, which I thought it was nice to define, and also moral hazard, because these two things play in with the financial crisis literature. Okay, so let me just speak a little bit more about mortgage-backed securities, which were the kind of the financial asset that led to this crisis. Okay, so a mortgage-backed security. So this is an investment similar to a bond. So a security is a bond, and a bond or a security is a financial asset that pays you a fixed payment or pays you a payment every month or every specified period, and then at the end, when it expires, you cash it out for the coupon value. All right. So instead of getting payments as a percent interest, you get predetermined payments, and you get those payments every period. Okay, so the difference here, as opposed to like a government bond, where you basically lend money to the U.S. government and they give you a payment every year or so. What these do is they're made up of home loans, and so the bond payment is the home loan. So investors who buy these assets, they instead of getting a coupon payment, they get the payment from the bond. So when you buy this asset as an investor, a mortgage-backed security, when the homeowner pays the mortgage, you get that payment. So your financial asset is recouped when you get the payment from the mortgage payer. So it works because you get a little bit of interest, and they pay the mortgage, and you get the mortgage payment. The problem was uh, these things stopped working because people stopped paying the mortgage, and then the people that own the financial asset didn't get the mortgage payment. Okay, so the MBS is a type of asset-backed security, with the asset being the house. The problem was the coupon payments, being the mortgage, were stopped being paid, and the person that held the mortgage-backed security didn't get their coupon payments. Okay, so basically, the mortgage-backed security, like we found out with the collapse, is it's only as good as the mortgage that backs it up. If you don't pay the mortgage, the investor doesn't get the payment, and both sides fail. Okay, so this type of financial asset was relatively new and just got really popular in 2008, 2007, 2009, and so much so that it led to the collapse. So there's a little more information on that here. And then one more thing, the concept of moral hazard. So this is the idea that a party protected in some way from risk will act differently or take more risk than if it didn't have protection. And so this plays into the big banks because knowing they had some potential for a bailout, they might have taken more risk than otherwise they wouldn't have. Okay, so basically, like if you think of insurance companies, um, the problem is, or the problem you want to look for is that by giving insurance, are you encouraging more reckless behavior by the people who are insured than otherwise not? So the moral hazard concept plays into financial markets and insurance. And the thing the what we're trying to say here with this concept is that uh, if you're acting more risky because you're in some way insured, then that's the moral hazard problem. Okay, so that's a little piece on the financial crisis, and I'd like to spend more time on it, but we have a lot of other stuff to cover in this semester. Um, I'd recommend watching this like a 10-minute video on the financial crisis, which I think is very useful. If you've read or seen, okay, so there's a book by Michael Lewis and also a movie called The Big Short, and either one is definitely it's worth watching or reading if you've seen those. And so this either movie or book is very informative, I think, of kind of what happened, at least from one side in the financial crisis. Okay, so if you get a chance to read that book or see the movie, if you haven't already, I'd highly recommend that. Okay. Uh, all right. So everybody doing okay so far? We following along? Any questions on the financial crisis or anything else we've covered? Okay. Excellent. So we got some more concepts to cover. And so we'll kind of jump and let's talk about the banking system. Okay, so the Federal Reserve banking system, or the banking system we're using in the United States, is a fractional reserve banking system. And let's define that, kind of what that means on slide 22. Okay, so our financial system operates under a fractional reserve system, which means that only a fraction of the money, only a fraction of like the notes are backed by the system. And so what that essentially means is that if everybody went to their savings and checking accounts and asked to take their money out, there wouldn't be enough money to pay them off. And so there's only a fraction of that actual money of it that actually exists. Everything else is just kind of paper notes and you know speculation. So the thing is that nobody really, I mean, no one's really going to do that because money's better as just in the bank or a savings institution. But just know that the concept of the fractional reserve system means only a fraction is backed. And so that essentially means that if every single person in the United States went to their checking account and savings account and asked for their money, there wouldn't be enough. Okay, but that's not going to happen. But that's the concept of the system. All right. So this concept started with the old profession called goldsmiths. And so what these individuals did is that back in the days when money was backed by gold, like you're in the early 1900s and before that, you had to have the total amount of money was backed by gold, so there wasn't more actual currency than the amount of gold in the United States. And so that meant that if you had your money as gold, it was kind of difficult to carry around. And so there's a few problems with that. If you had just your money in gold, number one, it was heavy, and number two, you can just get robbed and lose it all. Right. So there were some big problems with just having your money in big bricks of gold. So what the goldsmiths did is, as a profession, they took people's gold and gave them a receipt saying like, this is how much you have in our bank. And people preferred that because they had like an IOU, just a piece of paper, which is pretty much like a currency or a paper note that said you have $100, you have $1,000, whatever. Okay, and that was easier to travel around with and less easier to get stolen. Okay, and eventually those receipts that said you have this much in gold-backed currency just started being used as uh, currency, right? So originally you had to make transactions with gold. Then the goldsmiths started holding the gold and saying, giving people IOUs, saying you have this much gold. And then it just became easier just to make transactions with the receipts, with the IOUs. And this is essentially how currency started. Okay, and then eventually the goldsmiths, which became modern banks, they realized that people didn't really want the gold. They just wanted the piece of paper that said you have this much gold. And so they started issuing more uh, loans as IOUs or receipts or paper notes than they actually had. And so this started the fractional reserve system because they realized that people just want the notes, which are easier to use, and the currency than the actual gold. And so they started lending for interest rates more paper notes or more IOUs than they actually had backed by gold. And that's kind of how the fractional reserve system started, right? So this is uh, just the concept of money being backed by gold and then demand for the paper being higher than the gold itself. And then goldsmiths or banks just lending out more than they actually had because nobody came to actually get their gold. Okay. And the characteristics or concepts here is that banks can create money through lending. So we're essentially saying that banks can lend to customers by giving them currency at an interest rate, and that creates money because they're putting money into the system by just lending to their customers. Okay, and then banks are also subject to panics. Like if a lot of people start coming and taking their money out of banks, that can lead to problems, but it hasn't really been a problem for about 100 years now. Okay, let's talk about the required reserve ratio, which I defined down here. And that's going to lead us to the money multiplier and how you can create money through lending. All right, so the required reserve ratio is the required amount that banks have to keep in reserve and not lend out. So banks are money making institutions for profit, and they make their profits by lending out money at interest they get. So in theory, they'd like to lend out all their money, but they can't do that just in case there's some kind of panic or some kind of something happens where people you just want to have some money in the bank and not lend all of it out. And the Federal Reserve determines how much they cannot lend out just in case, just to have in reserve. Okay, so what's the reserve ratio? It's the portion of reservable liabilities that commercial banks must hold rather than lend out. Okay, so this is determined by the central bank, the Federal Reserve, and so banking institutions are required to hold some of their um, reserves against their assets or deposits, which can't be lent out. All right, so you have to hold like 10% or 5% or whatever the requirement is, and you can't lend out everything just in case there's some kind of panic or just to have the money for rainy days. So banks cannot lend out all their money, and they can only lend out in excess of the reserve requirement. All right, so let's talk about creating money by a bank issuing a loan. And so in slide 32, let's see what we mean here. All right, so we're trying to show here that when a bank makes a loan, it essentially goes into the customer's checkable deposits, like you're creating money by giving your customer a loan, and it goes into their checkable deposits. They get money in their checking account, and by doing that, they're creating money because that money wasn't otherwise there. So they're adding to the M1 or the M2. Okay, and so number one, a bank can create money by lending, and number two, a bank can only lend the amount in excess uh, of their pre-loan excess reserve. So they can only lend out what's in excess of what they have to keep on reserve. Okay, so like a one for one. So by making a loan or by yeah, so think of so our definition of money supply M1 is currency plus checkable deposits. So we define money M1 is currency plus checkable deposits, and so this concept basically, if a bank issues a loan, you can think of that money going into the customer's checkable deposits. And so by definition, this value, the checkable deposits would increase and the M1 would increase. So by issuing a loan, you're increasing the M1, the money supply, and so you're creating money by issuing loans. And so that's the concept here is that a single bank, by the definition of M1, can create money by issuing a loan. Okay, so a single bank can only lend in excess of its free loan excess reserves. Like if if you have $100 deposited and the reserve requirement is 10%, you can only lend out 90. You have to keep the other 10. Okay, so it's just you can only lend out what you have in excess. The reserve part you have to keep on reserve. But the banking system as a whole can kind of create a multiple of new money. All right, so if we look at the banking system as a whole on slide 33, how it relates to this concept of creating money. Okay, so we have this little example. So basically, we're saying that uh, the excess lending of one bank can create a multiple of that into the whole banking system. So the $90 that one bank can lend out can create more than $90 of new money in the whole banking system. So there's a money multiplier. There's a multiple amount of money creation that can be created by making a loan. All right, and so let's assume for this little example that we have a 20% required reserve, so you can lend out the other 80%. Okay, then all banks are loaned up, meaning that they're loaning that all the loans they can make, they're doing that because they make their money by making loans, and so all the loans they can make, they've done that. So they made all the loans they could possibly make. They're loaned up, and that means that they lend all of their excess reserves. So anything they can lend, they lend. And then let's assume that there's a $100 bill found and deposited, and let's show how that $100 can create more than the excess reserves for the whole banking system. And if we look at slide 36, this is a nice one. All right, so if you can see this here, this illustrates the example of creating the multiple of money, not just the excess reserves from one bank. So let's start here. So remember we had the $100 deposited, and the reserve ratio is 20%. So here's the first bank, Bank A. They get $100, and some customer deposits $100. The reserve ratio is 20%, which means they have to keep $20 of the 100 on reserve, but they can lend out the other 80. So that bank lends out the excess reserves, the other 80%. Okay, so basically that one bank, Bank A, created $80 new money, and that's the excess part of their reserves. Now, but if you go through the whole bank system, what you do here is the exercise is this other customer gets the $80 lent by Bank A, and then they spend it in another way. So this customer buys a nice dinner, and then the restaurant deposits that $80 in their bank, Bank B, and then Bank B keeps 20% of 80, which is 16, and lends out the other 64. And then the customer in Bank B, they get a loan for $64, the excess reserves for Bank B, and they buy like a video game. Okay, then the video game company deposits $64 in their bank, Bank C, and you see the process. So each amount that's lent gets spent and put into another bank from the business, and there's a trickle down effect because it creating more and more money. And given this example, the $80 that was lent out by Bank A can create up to a total of $400 of new money. Okay, so you can see, like, we're not going to go through all the banks, but you can see that the first bank's excess reserves are lent out, spent, and they're deposited from that business into Bank B. Bank B lends out $64, and this customer spends to another business, and they deposit into Bank C, and it keeps going down. All right, so the concept here, the point is that one bank can only create new money in excess of their individual excess reserves, but the banking system as a whole can create a multiple and create more money than just the excess reserves of the individual banks. So the Bank A can create $80 of new money. The whole banking system can create up to, in this case, $400. Okay, if that makes sense, that'll help you understand the monetary or the money multiplier. Okay, so again, although each individual bank can only safely lend an amount equal to its excess reserves, the commercial banking sector as a whole, the banking system as a whole, can lend by a multiple of its collective excess reserves. All right, so one bank can create money, but that new money is only their excess reserves. The whole banking system can create lots more than that, given that trickle down effect from business to bank, and so on. Okay, so this leads us to the monetary multiplier, little m, on slides 37 and 38. Okay, so the monetary multiplier is defined exactly as 1 divided by the required reserve ratio. So 1 divided by R. Big R is the reserve ratio. So you can see how this relates to the last slide. Okay, so look, the reserve ratio was 0.2 or 20%. All right, so 1 divided by 0.2 is 5. All right, so the monetary multiplier in the previous example was 5, and if you look at the new money that was created, it makes total sense that the excess reserves of the one bank times the monetary multiplier 5 give us the total creation potential of 400. So that's how this relates. So 80 times 5 gave us that potential 400. All right, so see how that works here? Everything is directly related to the reserve ratio, which in this example was 0.2. Okay, so that gave us the monetary multiplier of 5, and then any excess reserves by any bank can potentially create a multiple of 5 times that new money. So this excess reserves of the one bank times the money creating potential of the monetary multiplier 5 can create up to $400. Okay, so the reserve ratio can be different, or the deposit can be different, but the concept is the same. All right, this is always how you get the monetary multiplier, and this is always how you show how much money can possibly be created by just one excess reserve deposit. Okay, so the monetary multiplier is the maximum amount of new money created by a single dollar of excess reserves. Okay, so like you see the trade-off there, the higher the R, the higher the reserve ratio, the lower the M. And that should make total sense because the more money that has to be kept on reserve that you can't lend out lowers the potential of creating money, right? So the more you have to keep in the vault, the less you can lend out, and the less you can keep in the vault, you can lend out more and create more money making potential. Okay, it also works in the other direction. So we've learned that making loans creates money, but if customers pay off their loans, that eliminates money because it takes money out of checkable deposits and by definition lowers the M1. So the monetary multiplier can work the other direction too. If loans are paid off, that eliminates money from the M1. Okay, so we had basically a lot of definitions and concepts here, but I wanted to introduce all this stuff in money, banking, and finance. So just know the functions of money, uh, what liquidity is, and how that relates to the more liquid definition of money supply M1 and M1 plus near monies. And also, we looked at the data, how those two things the trends have really increased in the last half a year or so. Okay, just a little bit about the Federal Reserve and how that's the central bank uh, separate from the US government and some of their key functions. We looked a little bit about the financial crisis of 2007 2008, how that was caused by this mortgage backed security asset, and that led to the concept of moral hazard. A little bit about the fractional reserve banking system, how that was created, and how all money is not actually backed by currency. Okay, the required reserve ratio is the amount that banks have to keep on reserve, and banks can create money by lending equal to their excess reserves, but the banking system as a whole can create by a multiple amount of new money according to how you get the monetary multiplier, right, which was 1 over R. Okay, and then there's some optional videos. Nice one on money and finance. This one gives like a little 5 minutes on how banks create money. And then again, this one is on the financial crisis. So take a look at those videos if you get a chance. We went through these definitions, but you can click on the link if you want more on liquidity, mortgage-backed securities, moral hazard, and the required reserve ratio. Okay, so any questions or on any of this stuff before we look at some examples? All right, let's look at some examples. Okay, number one, this one is just a brief example of how you calculate M1 and M2 based on what goes into it. Okay, so assume the following assets in millions of dollars exist in Iron Mania, sorry. We have Federal Reserve notes in circulation, 700. We have money market mutual funds, 400 million. Corporate bonds, 300. Iron ore deposits, 50. Currency in commercial banks, 100. Savings deposits, 140. Checkable deposits, 1,500. Small time deposits, 100. And then coins in circulation, 40. So let's use that little description of items to calculate what is M1 in Iron Mania. So remember, M1 is just currency plus checkable deposits. Okay, so start with that. And all you have to do now is put in the currency and then put in the checkable deposits, sum them together, and that is your M1 in millions. So there's two portions of currency. So notes in circulation, like the green bills, that's 700. And then also you've got to add the coins, all the quarters and nickels and dimes and pennies. That's also part of currency. So if you add the notes plus the coins, okay, that gives you the total currency. And then also add checkable deposits, which is 1,500. Okay, so M1 is 700 for the notes, 40 for the coins, and then 1,500 for checkable deposits, which gives us 2,240, and that's in millions. Okay, and then the slide told you what goes into M2. It was M1 plus the three things that are near monies. So it's M1 plus savings deposits, small denominated time deposits, and then money market mutual funds. So all you got to do is go through this example and start with the 2,240 from M1, and then savings deposits, 140, plus small denominated time deposits, 100, and plus money market mutual funds, which are 400, right? So add those together. 2,240 for M1, 140 for savings deposits, 100 for small time deposits, and then 400 for money market mutual funds. And that gives you 2,880. Okay, so pretty simple. Just start with the definitions and just make sure that you put the items that go into their specific definition. And there's a few things that you just ignore. So Federal Reserve notes in circulation goes into currency. Money market mutual funds goes here. And corporate bonds is not part of a definition of money. So if you see corporate bonds or securities or stocks, that's not a definition of money. Ignore that. Iron ore deposits, that's some kind of mineral. And you see here currency and commercial banks. Now you don't want to count that because you're counting it from the checkable deposit side. Okay, and so if you count it from the customer side. So if you count the customer side deposits and the currency in the banks, you're going to double count. So only count the checkable deposits, not the money in the banks. Okay, to avoid double counting. All right, then you got savings deposits, which go into M2. Checkable deposits, yeah. All right, so everything else is. Okay, number 2, let's suppose Lady Gaga goes to Vegas to play poker, and at the last minute, her record company says it will reimburse her 50% of any gambling losses that she incurs. And given this statement, will Lady Gaga wager more or less as a result of the reimbursement offer? And what concept does this illustrate that we talked about earlier? And so the idea here is that if she gambles, if she wins, she gets to keep all of it. If she loses, she gets reimbursed 50%, so she only loses 50% at most. And so given that deal, she's going to wager more. Okay, because there's a much higher risk of her winning than losing because she can only lose at most 50%. All right, so she's taking more risk as a result of the deal or the system. And so this illustrates that concept of moral hazard because she's acting essentially more risky or more reckless because of the reimbursement offer. All right, number 3, and so this one is a nice example of how you calculate excess reserves and then the monetary multiplier, and then how much money can be created. And if things change, like the reserve ratio, what happens? So number 3, bank customers just deposit $1 million in checkable deposits in the Iron Bank of Bravos. And let's answer these questions in response to this new $1 million in checkable deposits. And let's assume that R, or the reserve ratio, is 50%. All right, so A, what is the maximum amount of new loans the bank can make? So what are their excess reserves? So they have to keep the amount required on reserve. They can lend the excess amount. So in this example, they have to keep 50%. The reserve ratio is 50%. They can lend out the other 50%. So if they have to keep 50% of reserve, they can lend out the other 50% of $1 million, which is 500,000. So they have to keep half on reserve. They can lend out the other 500,000, which are excess reserves. Okay, and then B, what is the size of the monetary multiplier? So just use the simple definition where it's just 1 divided by R and put the reserve ratio in decimals. So the monetary multiplier is 1 divided by 50%, which is 0.5. And 1 divided by 0.5 is just 2. So the monetary multiplier is 2. Okay, C, let's calculate maximum checkable deposit creation. So how much money can be created given the excess reserves and given the monetary multiplier. All right, so you can use the simple formula where max checkable deposit creation, big D, is equal to E times M. So it's just excess reserves times the monetary multiplier. Okay, we already got those things. Excess reserves of 500,000. the monetary multiplier is 2, and so 2 times 500,000, we can create up to $1 million of new money creation with this original 500,000. Okay, so excess reserves are 500,000, the monetary multiplier is 2, and we can create up to $1 million of new money potential from that initial $500,000. Now D, what if something changes in particular the reserve ratio requirement? So let's answer A, B, and C on the assumption that the reserve ratio is lowered to 40%. Okay, so you should note that if the reserve ratio is lower, the uh, the bank can lend out more money, and there's also more creation potential because less is kept in the vault. So the reserve ratio is now 40%. All right, so if they have to keep 40% on reserve, they can lend out the other 60%. And so 60% of $1 million, they can now lend out 600,000, right? Okay, and then calculate the monetary multiplier, which is 1 divided by R. And so 1 divided by the reserve ratio is 40%, which is 0.4. 1 divided by 0.4, we now have a monetary multiplier of 2.5. Okay, now how much money can be created with this final part of the example with the new reserve ratio? So deposit creation is just excess reserves times the monetary multiplier. So we now have 600,000 to lend out. The new monetary multiplier is 2.5, and so that gives us a money making potential of 1,500,000 or 1.5 million. Okay, and what you can see here is that the Federal Reserve has a tool that we'll talk about next time more, but what you can see is if they lower the reserve ratio, the banking sector can lend out more and more money is created and they kind of increase the money supply. So by just modifying the reserve ratio, the Federal Reserve can increase or decrease the money supply. So lower reserve ratio, higher money multiplier, higher money supply. Lower or higher reserve ratio, more money is kept in the banks and less money is lent out, and that would decrease the money supply. So you can clearly see that the direct effect of the monetary or the reserve ratio is on the monetary multiplier, and the higher the reserve ratio, the lower the money supply. Okay. Any questions on these examples 1, 2, or 3? Okay. Let me just pull up the homework for chapter 14. Okay, homework assignments, chapter 14. All right, so here we go. Just two questions that are due next Wednesday. So homework chapter 14, you just got one, and there's the examples we just did are very similar here. So you got one on the money supply. So just go through the items and use those simple formulas and calculate M1, and then go through the items and calculate M2. All right, so just start with the original formulas and put the items in there, and don't put the ones in that don't go, but just use the identity to calculate M1 and then M2 like we did in the example. And then another one like we just did on the monetary multiplier and checkable deposit creation. So there's $100 in checkable deposits. The reserve ratio is 5%. And you're going to answer those similar questions like we just did. So we just calculate, given the $100 and the 5%, calculate excess reserves, the monetary multiplier, and checkable deposit creation, and just stick with the example and those simple equations. And then assume the reserve ratio is lower to 2.5%. That should create more money, and do the example there. All right, so both of these should be very similar to the examples we did. And two questions for chapter 14, which are due next Wednesday. Any questions on the homework assignment, or what I want you to do for the two homework questions? Okay, so next week we're going to finish up the last macroeconomics chapter and talk about monetary policy. And just note that, let's see, the chapter, some people already did the chapter 14. The chapter 13, 12 to 13 homework is due today. And, well, it looks, so if you, it looks like only two people have done it. So if you need a few more days on that, that's fine. But try to get the chapter 12 to 13 homework in soon. And then the chapter 14 homework is due next Wednesday. Okay, so everyone's good on the homework assignments, and we're getting close to being done, but yeah. Okay, what time? Okay, so I think I got everything I wanted to get done today for chapter 14. I tried to get us done a little early, and I think, yeah, it's a little before 8:15, so I think that's all we're going to do today. And I want to thank you guys all for coming on the night before Thanksgiving. I wasn't sure how many people would come, but we got a pretty good turnout. So thanks for participating. And let me know if you have any questions. But other than that, that's it for tonight. And have a great Thanksgiving and stay safe and spend time with your family. And I'll see you all next time on Wednesday.
Have a good night, Professor.
You too. Thanks.